In this video, we're going to take a deep dive into analyzing a property investment. Our focus will be on a real-world example, 14 Park Row, Nottingham. Let's start with the basics. The property has a quoting price of 3.3 million, reflecting a net initial yield of 9%. Now, what does that mean for potential investors? To understand that, we need to look at both the positives and the negatives of this investment. First, let's talk about the positives. The building itself is modern and appears to be in good condition. This is crucial because if a building needs significant repairs or upgrades, it can be costly and time-consuming for the new owner. Next, the specification and layout of the building meet modern standards. This includes features like open-plan offices, raised floors, air conditioning, and lift access to the upper floors. All of these aspects can impact the rent that occupiers are willing to pay for the space. Another strong point is that the property is freehold. This is the best type of interest a purchaser can have. Unlike leasehold properties, there are no superior landlords to deal with, and there's no ground rent to pay. This gives the owner greater flexibility and typically a better return on investment. The property is located in an established office area. This is important because the office use is well suited to the area, as evidenced by nearby occupiers like Turner and Townsend and Coutts Bank. Accessibility is another key factor. The property is located near excellent transport links, including the tram line and Nottingham station. There's also basement parking available, which is becoming increasingly rare. Good accessibility is critical for staff retention, business operations, and client relationships. The building is situated within Nottingham's central business district. This means it's in a prime location, surrounded by complementary uses like public buildings, restaurants, and banks. Nottingham itself is a well-populated city, centrally located in the East Midlands. It has good access to the M1 motorway and strong train connections to major cities like Manchester, Birmingham, and London. Currently, the property is fully let, although some leases are relatively short. It will be important to establish the tenant's plans because a fully let building could quickly have vacant spaces to worry about if tenants choose not to renew. Interestingly, the current passing rents seem to be below other rents in Nottingham. This suggests that there may be potential for a landlord to increase rents at rent review or lease renewal. With one tenant already leaving, the building will be market tested soon, and a favourable new letting rate could set a positive tone for future rent increases. ESG credentials could be another area for improvement. Implementing measures like water recycling, efficient heating systems, green travel schemes, bike shelters, EV charging points, and enhancing common areas could make the property more attractive to tenants. Biodiversity initiatives, like adding greenery to the roof, could also be considered. Finally, PV solar panels could be installed to reduce the property's on-site power consumption, making it more energy efficient and appealing. Now, let's consider the negatives. The EPC rating is a C, which is generally acceptable. However, the best occupiers are now seeking EPC A ratings and strong sustainability credentials. This could make newer buildings in Nottingham more competitive, potentially depreciating this property more quickly. The building was originally constructed in the 1980s, which means it's becoming quite old. Older offices often have less clear open floor space and less natural light compared to newer ones. Plus, materials and design styles have evolved significantly since the 1980s. The building does have a dedicated reception, which is essential for multi-occupancy buildings. However, it appears there's stepped access, which can limit appeal from an inclusion standpoint. It's a drawback if anyone needing disabled access can't use the front entrance. Since the building is multi-let, more asset management will be required. Multi-let buildings usually have a higher yield, but they also require more attention from the landlord. The landlord will retain responsibility for common areas, which may necessitate on-site staff. While these costs are covered by the service charge, it does take time and effort from the landlord to organize. One tenant has already served their break notice to leave, meaning the property won't be fully income-producing at purchase. This will require the landlord to cover void service charge payments, void business rates, and agent letting fees for a new tenant. Given that the building was constructed in the 1980s, there's a possibility of asbestos being present. As the landlord, you'll be responsible for maintaining all shared areas and common plant areas safely. There's another risk to consider. 3 out of 5 let spaces have lease renewals coming up in 2026, and one tenant has already served notice to leave. This means that 4 out of 5 tenant spaces could come back to the landlord. While this presents a value-add opportunity with potential rent increases, there's also significant void risk, which could lead to a drop in value in the short term. Risk-averse investors might find this too risky. When tenants leave, the property will likely require refurbishment, which means capital expenditure for the landlord. Therefore, a purchaser will probably conduct a building survey and deduct the cost of necessary repairs from their bid for the property. They'll also take advice from letting agents on likely rents per square foot once the space is refurbished. For an investor, the economic structure and size of Nottingham as a market will be an important consideration. The current tenants are sizable companies and seem unlikely to default on their rent, which is reassuring. However, the short lease terms are a concern. The landlord wouldn't want too much space to come back at once, as it could be challenging to re-let quickly. While the building presents fairly well, it's important to remember that the underlying asset dates back to the 1980s, which brings some capital expenditure risks. The value of this asset is a mix of the uncertain near-term future and the potential stabilized position once leases are renewed, and any vacant space is refurbished and re-let at higher rents. In summary, this property presents a fairly risky investment, but could offer attractive returns for knowledgeable and experienced investors, such as institutional funds and property companies. The key will be in managing the risks and capitalizing on the opportunities presented by the current market conditions. That wraps up our analysis of 14 Park Row, Nottingham. I hope this has given you valuable insights into how to approach property investment analysis, especially when preparing for the RICS APC. Thanks for watching, and be sure to like and subscribe for more real estate education content.